Hello, everyone, and welcome to the third and final session of our three-part tax saving tips for working professionals webinar series. Today, we're going to cover how to build your own tax plan. This session is being recorded and will be posted to our website at milestonefinancialplanning.com in case you'd like to reference back to anything we talk about. If you haven't done so already, I do recommend going and watching the first two webinars in this series as it provides a lot of content towards today's discussion. If you have any questions as we go along, please leave them in the Q&A section. I plan to leave 5 to 10 minutes to answer any of these questions. I'd like to introduce myself. My name is Kyle Abell, and I'm an advisor at Milestone Financial Planning. Milestone is a fee-only investment management firm based out of Bedford, New Hampshire. We have additional offices in Peterborough and Newmarket, New Hampshire, as well as Westford, Massachusetts. We help clients around the country with their financial and tax planning needs. You can connect with me on LinkedIn and learn more about Milestone by visiting our website at milestonefinancialplanning.com. A few quick disclaimers before we get into today's content. Nothing you hear today should be considered tax, financial, or investment advice. Do not make financial or investment decisions based on this or any other webinar. Instead, meet with a qualified financial advisor regarding your specific goals and financial circumstances before making major financial decisions. Note that almost all financial decisions will impact your income taxes or estate taxes now or in the future, and the consequences should be evaluated before you take action. Past performance of investments does not predict future results, and advisory services are only offered to clients or prospective clients where Milestone and its representatives are properly licensed or exempt from licensure. Our series covers tax-saving tips for working professionals. In the first session, we introduced how the U.S. income tax system worked and many of the tips and techniques that we cover throughout this series. In the second session, we elaborated on some of these techniques to help you understand what fits your needs as a working professional. Finally, today, the goal is to bring this all together and show you how you can combine different tips and techniques to build your own customized tax plan. Without further ado, let's look at how to do this. We're going to look at a 4-step process to building a tax plan. Before we do so, I would like to note that the goal is actually tax planning and it's ongoing tax planning rather than creating a one-time static tax plan. That's because things change, life changes, income changes, tax laws change, and you want to make sure whatever you're doing is addressing the circumstances at hand. The best way to do that is by reviewing your tax planning each and every year and actually doing so throughout each year to make sure that what you're implementing is still the right course of action. Now, to build that tax plan, you're going to start off by evaluating your lifetime tax situation. From there, you can compare how this year fits into that lifetime framework. Step 2 is going to take a high-level overview of this year's situation. After you've done that, you're going to move on to step 3, where you actually create an in-depth current year tax projection. Finally, with all of that data, you can start choosing the appropriate planning techniques and strategies to implement for you to hopefully reduce your lifetime tax burden. And that's the true goal of tax planning, is reducing your tax burden so you have more money to meet your goals in life and finance. Now let's look at each of these steps in a little more detail. Before you go through and start doing your tax planning, you always want to revisit your goals. And we're going to do that throughout today's session. That's because the techniques that you implement should help you achieve those goals. Depending on what they are, you might want to choose one course of action over another. Now, with your goals in mind, we're going to look to see what your overall lifetime tax situation is going to look like. Is your income and taxes increasing over time? Is it decreasing over time? Or is it going to stay the same? To do this, we're going to look at estimating what your marginal tax bracket is each and every year into the future. We're going to do the same thing with your effective tax rate. Now, your marginal tax bracket is what you're paying in taxes on that last dollar of income earned. For instance, if the last dollar of income is being taxed at 24%, then that is what your federal marginal tax bracket is. Whereas your effective tax rate is calculated by taking your total tax and dividing that by your taxable income. For instance, if you pay $20,000 in federal taxes this year and have $200,000 of taxable income, then your effective tax rate would be 10%. These two numbers can help give you guideposts to compare one year versus another. This is where you come to step 2, where you take this year's situation and put it into the context of that lifetime framework. In step 2, you're going to determine from a high level whether this year is going to be significantly higher than average, lower than average, or close to a normal tax year. This can help give you some sense of whether you want to implement income reduction techniques, income acceleration techniques, or kind of just stay the course. Once we have that information and see how this year on a high level compares to your lifetime framework, we can go ahead and start building an in-depth current year tax projection. And I actually recommend doing this multiple times throughout the year because, again, income can change. You might change a job, you could get a large bonus, or you could have more investment income than you otherwise thought you would. And going through step 3 and updating your tax projection along the way can make sure whatever techniques you implement are appropriate for you. During this process, really what we're going to focus on in step 3 are any tax phase outs, phase ins, or cliffs that you might be near. This can change what you might want to implement coming from step 2 into step 3. Now, we personally use our crunching numbers tool, which you can find on our website to do this. It provides a lot of information on all of these numbers, and we update it each and every year to make sure that the data is as accurate as possible. Finally, once we've gone through all of this, we can get to the phase where we start choosing and implementing what planning strategies we're going to do. Are we going to do income reduction techniques? Are we going to do income acceleration techniques this year? And if so, how much? For instance, if you want to increase your income in a given year, maybe you choose to do Roth conversions. This is going to increase your adjusted gross income and the amount of money you're going to pay in taxes now to limit potentially the amount you're going to pay later on. In step 4, you're going to choose how much of those conversions to do. Are you doing $10,000? Are you doing $100,000? You can refine this at this step in the process by looking at those phase outs, phase ins, and credits that I talked about. One thing that I like to do is do Roth conversions up to the top of a certain marginal tax bracket. For instance, maybe we're going to convert to the top of the 24% bracket or the 22% bracket for a client. This is a great way to start looking at this stuff. Now, we're going to look at 3 different case studies to see how to put these steps into action. Hopefully, afterwards, you get a few tips and techniques that you can use for yourself to help you design your own tax plan so you have more money to help pursue what you want out of life. We're going to start off by looking at Noah and Emma, a 40-year-old couple with 2 young kids. From there, we're going to move on to Mike and Jen, who are in their 50s, with 1 child in college and another entering college in a couple of years. Finally, we're going to end today's session and this series by looking at David and Mary, a 60-year-old couple looking to retire in the near future. The way we're going to structure this is by looking at some information about each of these couples. Then we're going to go over their goals. And finally, we're going to go through that 4-step tax planning process that I mentioned earlier. Without further ado, let's look at Noah and Emma. As I mentioned, they are both 40 years old and they live in Massachusetts. Right off the bat, what I'm thinking is that Massachusetts has income taxes, so they might want to plan around this. Additionally, because they're paying income taxes to Massachusetts, they're going to have something that they can deduct on their tax return and potentially allow them to itemize their deductions later on. We'll see if this is the case as we go through. Noah earns about $400,000 this year between his salary and his restricted stock units. This is going to show up as wage, salary, or compensation income. Emma isn't working anymore and is instead a stay-at-home mom taking care of their 2 young kids, Sophia and Ava. Because they have 2 kids under the age of 18, they might be able to utilize something known as a child tax credit. This provides you a $2,000 credit for each dependent child under the age of 18, which helps offset some of your tax burden. Now, they do have money in their retirement accounts already. Noah has about $400,000 in a traditional IRA, $200,000 in a Roth IRA, and $100,000 in his company 401k plan. Emma has $150,000 in her Roth IRA. What I am thinking about at this moment is that Emma doesn't have any money in her traditional IRA accounts, and they're high earners. This means that they may want to look at something called the backdoor Roth strategy. We'll see if this is the case as we go throughout. They have $100,000 in a taxable brokerage account, which means we're going to have to account for some amount of investment income for them this year. We'll get to this as we look at their tax projection. Finally, they have a mortgage at a pretty high interest rate, meaning they'll likely have a lot of mortgage interest, which can be deducted on their tax return. Before we look at the actual tax planning process, let's think about their goals. Noah and Emma's primary focus at this point is saving for Sophia and Ava's college educations. They also want to pay off their mortgage, save for a vacation home, continue working towards retirement, and donate money to charity each year, around $5,000. Let's see if there are ways that we can help them achieve each and every one of these. The first step is looking at what their lifetime tax situation is. This graph here shows their highest marginal tax bracket each and every year between now and when we presume they pass away in their 90s. What we can see from this graph is that during Noah's working years up until age 60, they are in a higher marginal tax bracket than what they're going to be in later on. That means the last dollars of income earned are going to be at a higher tax rate than when they take money out of these accounts in retirement. This is an indication that Noah and Emma are probably going to want to put money into their traditional retirement accounts and work on reducing their taxes and taxable income. If, on the other hand, their income was lower now than in retirement, they'd probably want to do the opposite. Look at either accelerating some of their income or making Roth contributions. But let's see if this is the case as we continue through this process. The next step is looking at this year from a high level and comparing it to their lifetime framework. The two things we're going to want to look at are their effective tax rate and their marginal tax rate. Their effective tax rate is around 20% and marginal tax rate is 24%. We're going to take these numbers and then compare it to this lifetime framework. We can see that being in the 24% marginal bracket is slightly lower than what it's going to be moving forward. Over the next few years, they're going to be in the 32% bracket. However, once they retire and during their RMD years, they're going to be in either the 24% or lower tax bracket. This is another indication that Noah and Emma want to try and defer some of their income so that they can pay money at lower rates later on than what they would today. With this picture in place, we can look at creating an in-depth tax projection to see if there's anything else that we should think about. Here, we're going to pay attention to certain income thresholds that exist in the tax code. Some of the things that are pertinent to Noah and Emma are the net investment income tax, Medicare surtax, and the child tax credit phase out. The net investment income tax is an additional tax on investment income. This is going to increase their overall effective tax rate, but it's not going to show up in that marginal tax bracket number that we just looked at. That's why I like to look at both the effective tax rate and marginal tax rate when doing this planning. They're also going to have additional taxes coming from that Medicare surtax. Now, this is on compensation income rather than investment income. Finally, they're likely going to start phasing out of that child tax credit. That's because that phase out starts at $400,000 of MAGI, and their compensation income alone was $400,000. So let's see what their tax situation looks like before doing any planning. As I mentioned, they have $400,000 of compensation wage income this year. We also have an estimate in here for dividends coming out of their taxable brokerage account. They have $100,000 in that account, and it's going to almost certainly generate some amount of investment income. Additionally, I have an estimate here that they're going to pay $2,000 in capital gains. Now, this estimate is assuming that Noah sells his restricted stock units as soon as they vest. This is something that I recommend most of my clients do to help reduce their concentration in their employer and reduce their overall risk if something happens to that company. Now, once we add all of this up, we see that their adjusted gross income is going to be $405,000. As I mentioned, that is above the $400,000 phase out limit for that child tax credit. This means that they're going to start losing some of that tax credit, which is in essence an additional tax to them. Now, before we get there, let's look at their deductions. I already mentioned that they live in Massachusetts, which has income taxes, so they can deduct some of these on their tax return. However, there is a limit to the amount of state and local taxes that you can deduct each year, and it's currently $10,000. They have that mortgage and are paying mortgage interest, And we're saying that they're going to have about $32,000 worth of it this year, which can also help reduce their taxes. Finally, they are giving to charity using cash donations and can deduct that as well. We end up with their taxable income of $358,050. Your taxable income number is what determines what marginal tax bracket you're going to be in. And as we discussed, Noah and Emma are in the 24% bracket. We can also see that their child tax credit was reduced by $250. Again, this is in essence an additional tax to them. Now, they are also subject to miscellaneous taxes on their investment income from that net investment income tax and on their Medicare surtax. This is increasing what they have to pay this year. In total, they're going to have to pay about $70,000 worth of total taxes before doing any plan. Now we get to the step where we can start looking at tips, techniques, and strategies to implement for Noah and Emma. As we've gone along, we've seen that they want to try and reduce their income as much as possible at the moment because they're going to pay taxes at a lower rate later on than they are today. For instance, if they are paying tax at 10% later and are able to defer income, which would be taxed at 24%, then they save 14% in taxes on that money. This is a great way to reduce your overall lifetime tax burden. Before we look at specific tips and techniques, we always want to touch back in on our goals. For Noah and Emma, this is saving for Sophia and Ava's college, paying off their mortgage on their primary home, saving for a vacation house, retiring, and donating money to charity. Because they're itemizing their deductions, we don't necessarily need to look for advanced planning techniques to donate to charity. They're already getting a tax benefit for doing so. Now, we can look at ways for them to save for college in an efficient manner and potentially increase their cash flow to pay off their mortgage or save for a vacation house, as well as move towards retirement. Some of the tips and techniques that I would recommend Noah and Emma do are: one, maximizing their 401k contributions. This is something that Noah can do. The benefit of this is they're putting money away for college and they're reducing their income today. They're then going to be taxed at a potentially lower rate later on when they're taking money out of these accounts. I would also recommend that they maximize their HSA contributions. Health savings accounts are a great way to reduce your lifetime tax burden because you get a tax deduction for putting money in. Money grows in the account tax deferred, and it can be taken out tax-free later on. This means you may never pay any taxes on money inside of an HSA account. This is a great way to reduce your lifetime taxes. Now, they can also reduce their tax burden this year with those cash donations to charity. We don't have to do anything fancy with that. I would also recommend Noah take advantage of his mega backdoor Roth 401k. This is a way to get a lot more money into your tax-free retirement accounts than you typically can do. Otherwise, this money might have to go into a taxable brokerage account, which, as I've discussed, is subject to investment incomes and potentially that net investment income tax each and every year. I would have Emma use that backdoor Roth strategy. This is a way for them to save more money in tax-free accounts than they otherwise could do. They can do it because they are over the regular Roth IRA contribution limit, meaning they can't use the front door to put money into that account. Additionally, only Emma can do this because she doesn't have traditional IRA assets. If she did, this strategy wouldn't be available to her. But it is a way to get an additional $7,000 into that tax-free bucket. I would also recommend they fund 529 plans for Sophia and Ava. These are college savings plans and are a tax-efficient way to start saving for those education costs later on. Otherwise, they would be putting money into that taxable brokerage account, which would be subject to investment income either over time or potentially when they sell some of the funds and generate capital gains. Finally, I would have Noah sell his RSUs to start funding either that vacation home fund or paying down their mortgage, which they said were important to them. So let's look at how things are after that tax planning. First off, we see that their wages have decreased quite a bit by over $31,000. Again, that's from the 401k and HSA contributions. This is going to help reduce the amount that they're paying in that Medicare surtax because that's based off of compensation income. It's important to think about what types of income things are based off of because there's numerous different types. It could be your taxable income, it could be your adjusted gross income, and you really want to make sure that you are paying attention to the right numbers. Now, Noah and Emma haven't changed the amount of dividends or capital gains they're going to have this year, and we get an adjusted gross income of $373,700. This is going to be below that $400,000 phase out for the child tax credit. This means that they're going to preserve the full amount of that credit and get a $4,000 reduction in their tax bill at the end of the year. We don't see any changes in the amount of deductions that they have because we're not doing any tax planning around those items. They're already benefiting from donating to charity, so we don't have to do anything fancy. We also see that their miscellaneous taxes were reduced. Again, this is the reduction of that Medicare surtax. Ultimately, Noah and Emma were able to save about $8,000 in taxes this year, which they can use to fund some of their other goals. They could put this towards their mortgage, they could put it towards that home fund, or just general savings for either college or retirement. We were also able to help them save for retirement, save for college for their children, and have this cash flow for their vacation home fund by selling their RSUs, helping them move towards some of their goals. Next up, we're going to look at Mike and Jen. Mike and Jen are both in their 50s and live in New Hampshire. They earn together $250,000 worth of compensation income. They also have two children, Jacob and Madeline. Now, because they live in New Hampshire, they aren't going to be paying any income taxes, so we're probably not going to do any planning around that. Additionally, it's an indication they may not be able to deduct their taxes this year. That could be a reason to do some advanced strategies or not, depending on what their goals are. And we'll get to that in a minute. Now, because they have two dependent children, they might be able to use that child tax credit. However, only Madeline will qualify for it because she's under the age of 18. Since Jacob is not, they may be able to get a credit for him, but this time it's going to be known as the other dependent credit, and it's going to be limited to $500 rather than the $2,000 that they get for Madeline. They do have considerable assets in their retirement accounts already. Mike has $400,000 in his 401k, $400,000 in his traditional IRA, and $300,000 in a Roth IRA. This is a good mix between pre-tax and tax-free assets, which is something that I like to see, especially as clients enter retirement. It gives you additional tax flexibility to do various strategies. Jen also has money in her pre-tax and Roth accounts with $150,000 between her 403B and traditional IRA and $150,000 in her Roth IRA. Because both of them have money in their traditional IRAs, they're not going to be able to utilize that backdoor Roth strategy. So we might look for other ways to build up that tax-free account. They also have money in a joint brokerage account, which is going to generate that investment income each year. They are having a lot of cash flow issues because Jacob's in college and they're paying for his college costs. They plan to do the same thing for Madeline later on. However, they don't have to worry about their mortgage at this point, so it's not as critical for them. Now let's look at Mike and Jen's goals. Their primary goal at this point is to pay for college for Jacob and Madeline. Because of this, they're probably going to look at ways to increase their cash flow, either by reducing their taxes or some other means. Additionally, they want to continue to save for retirement, with Mike wanting to do so in 10 years and Jen wanting to retire in about 15. So let's see what their tax planning looks like. Once again, we're going to look at this their federal marginal tax bracket to see how that's going to change over time. For Mike and Jen, it does change quite a bit. It looks like it's going to go up in the near future. Then it's going to stay pretty high while both of them are working. Once Mike retires, it drops a little bit. Then it drops significantly once both of them are retired, but increases once their required minimum distributions kick in at 75, and increases more there as those RMDs get larger and larger and larger. Right now, we're getting a kind of mixed signal of what Mike and Jen might want to do. It's not clear that their income is going to be lower in retirement than it is now, or that it's going to be higher than it is now. So we don't know for sure whether they're looking at income reduction or acceleration techniques at this point. So let's move on to step 2. In step 2, once again, we're going to look at their effective tax rate and marginal tax rate. For Mike and Jen, their effective rate is about 17%, and their marginal rate is 24%. We can take these numbers and compare it to that lifetime tax situation once more. Being in the 24% bracket means that they're slightly lower than what they're going to be in the future, higher than what they're going to be in retirement in those early years, but the same or lower than what's going to be in their later years. Again, we're getting mixed signals as to what they might want to do. Hopefully, step 3 will help clarify this. And this is where we're going to compare their tax situation to some of these key income items. Those items for Mike and Jen are, again, the presence of net investment income tax, the Medicare surtax. For them specifically, the Roth IRA contribution phase out is a very key item, but the child tax credit phase out isn't as important because their income significantly below that $400,000 mark. You really want to compare your income to some of the key thresholds around you to make sure your planning is as accurate as possible. For Mike and Jen, they have $250,000 of compensation income this year. They have an additional $5,000 estimate for dividends. Now, with all of these case studies, I would refine that estimate for your dividend income throughout the year. This is because it can change quite significantly, and you want to make sure your planning is as accurate as possible. I highly recommend doing an update to any tax projection you make in either November or December to be as close to accurate as possible. Now, for Mike and Jen, I have an estimate here that they're going to have $10,000 worth of capital gains this year. These capital gains are going to come from the need to pay for Jacob's college education because they don't have the cash flow to do so on their own. Instead, they're going to have to sell some of the money in their taxable brokerage account to fund those distributions. This is why proactive tax planning is important. With Mike and Jen, they did not put money into those 529 plans ahead of time like we recommended Noah and Emma do. Because of that, when they're taking money out of the account to pay for college, they're going to have to pay taxes on that. And they probably had to pay additional taxes such as dividends along the way. Adding all of this up, we see that their adjusted gross income is $265,000. That's going to be above the mark for that Roth IRA contribution phase out, which starts at $230,000 and ends at $240,000 of modified adjusted gross income. This is a key number for them, and because by getting below this threshold, they could put even more money into their tax-free retirement accounts. Before we get there, let's look at the rest of their tax situation. Unlike with Noah and Emma, Mike and Jen cannot itemize their deductions. That's because they don't have any mortgage interest and they don't live in a state that has income taxes. Additionally, they don't have a goal of paying for putting money towards charity at this time. So we can see that their taxable income is $235,800, putting them in the 24% tax bracket. They do get tax credits, and we're not too worried about those. They get $2,000 from the child tax credit and $500 from the other dependent credit for Jacob. These two things help reduce their tax burden, and they're not at risk of losing them, so we're not going to worry about them. They do have some miscellaneous taxes coming from that net investment income. That's because they have those dividends and capital gains and are above the threshold of $250,000 of NAGI. In total, before doing any planning, they have a total tax obligation of around $40,000. Now, we've seen a muddy picture throughout this process. In steps 1 and 2, we couldn't tell whether they want to reduce their income or increase it. However, step 3 gave us a lot more information. And the most critical one is that they are close enough to that Roth IRA contribution phase out that they can get below it and start maximizing contributions to their Roth IRAs this year. This gives me the indication that they're going to want to reduce their income rather than accelerating. However, because it's a little muddy, we might want to do a little bit of both just to hedge our bets. However, before we get there, let's revisit their goals one more time. The primary goal at this point is paying for college, and to do that, they're probably going to have to increase their cash flow a little bit. They do want to continue to work towards retirement in the near future. Some strategies that they can use to accomplish these goals are, like Noah, Mike is going to maximize his traditional 401k contributions. However, because he's 50 years old, he can do an extra $7,500 contribution to his traditional 401k this year as a catch-up. I would also have Mike maximize contributions to his HSA for the same reasons that I recommended it to Noah. These two items will help reduce their compensation income and their AGI. helping push them below that Roth IRA contribution phase out. Now, because their situation is kind of muddied, I would probably have Jen put some amount into her Roth 403b. But because they have cash flow constraints, she's probably not going to be able to maximize those contributions on her own. So I would have her put in some percentage of her salary, which after doing their numbers, it would be about 15%. This is going to get more money into that tax-free bucket and limit the size of their RMDs in the future. Now, because they're underneath the Roth IRA contribution phase out, I would have them maximize those Roth IRAs before putting more money into the Roth 403b. That's because IRAs tend to be more flexible, have lower costs, and tend to have lower fees than employer-sponsored retirement plans like 401ks and 403bs. Finally, with Mike and Jen, I would recommend they use that taxable brokerage account to start paying for some of Jacob's college educations. This is going to generate investment income, but it's a means to help achieve their goals. Let's see what the results are after all of this planning. We can see that their wages were reduced quite significantly by almost $40,000. Now that's going to be from the traditional 401k contributions and HSA contributions. The other income items didn't change because we're not really manipulating that taxable brokerage account from the before to the after scenario. Beforehand, we were still planning on using the taxable brokerage account to pay for college, and we're doing the same now. However, we can see that their AGI is now below that $230,000 mark, so they can maximize those Roth IRA contributions. We don't see any changes to their deductions or credits since they're below the credit phase out limits and they're not doing any planning around deductions. Finally, they were able to eliminate their miscellaneous taxes. This is because their income is now below the point where the net investment income tax is starting to kick in. Remember, they didn't have to worry about the Medicare surtax because that's based off of compensation income rather than some of these other numbers. In total, they were able to save over $9,000 in taxes this year, which can be used to start funding some of those other goals. It could be used to fund some of their retirement contributions or reduce the amount that they have to take out of their taxable brokerage account to pay for college. This can be a great way to help Mike and Jen move closer towards their ultimate end goal. Now we're going to finish up by looking at David and Mary. They are a 60-year-old couple that also lives in Massachusetts. So once again, I'm going to be thinking about state income taxes and the ramifications of it. David is a professor and earns $150,000, while Mary earns $75,000. Together, they earn $225,000 worth of compensation income. David has a lot of money in pre-tax retirement accounts, with $1 million in his 403b and $750,000 in a traditional IRA. However, he doesn't have any money in his tax-free Roth bucket. Neither does Mary, for that matter. She does have $500,000 in pre-tax assets between the 401k and the traditional IRA, but she doesn't have any Roth money. As you get closer to retirement, it becomes even more important to have money in different buckets. That's because it gives you flexibility if you need money in retirement rather than having to rely on your pre-tax accounts. If you have to rely on those pre-tax accounts, it means you're going to generate additional income, which in and of itself is going to generate additional taxes to you. So having money in these different buckets allows you to choose what your income is going to be for the year. Now, they do have money in a joint brokerage account. This is going to be subject to that investment income tax, but it gives them some flexibility. They may not need to get as much money into Roth accounts because they could tap this joint brokerage account. They don't have a mortgage either, and their house is worth about $750,000. Finally, their children have moved out and are now self-sufficient, so they're not going to be part of any tax credits for David and Mary. Before we look at their planning, let's look at their goals. They want to retire in the next few years. That is the most important thing to them at this stage in life. Additionally, in retirement, they'd like to move from Massachusetts to Maine. For those who aren't familiar, both Massachusetts and Maine have state income taxes, so moving from one to the other really isn't going to change things too much from a tax perspective. However, if they want to move from, say, Massachusetts to New Hampshire, that could have a material impact on their planning because New Hampshire doesn't have state income taxes. This means that whatever that state tax rate is would be eliminated once they move and can change what they want to do now. David and Mary like to donate to charity and donate a fairly considerable amount, targeting $10,000 per year. And this is something that we're going to monitor throughout their case study. Finally, they would like to pay for their children's wedding in the near future, but because they have that taxable brokerage account, they probably have the assets to do so without requiring a lot of tax planning. Not all of your goals will require tax planning, but some of them do. And if they do, then the planning itself can help move you closer to achieving them. So let's look at David and Mary's overall situation. As we can see here, once again, their tax bracket changes quite a bit over time. It increases in the near future, then it drops dramatically during their first few years of retirement. This is a great opportunity for them to do some income acceleration techniques like Roth conversions or capital gain harvesting. I discussed these in webinars 1 and 2 in case you'd like more information on them. Then, as they get further into retirement and the required minimum distributions kick in, they're getting back into the same tax bracket, if not a higher bracket than what they're in at the moment. This is an indication that they want to stop putting money into their pre-tax retirement accounts. Another reason they might want to stop that is they have no money in their Roth bucket at all. These two factors alone could be a huge reason to choose Roth contributions, even if it otherwise didn't make sense. Because let's say when you're 70 years old and retired, you want to take a trip around the world that's going to cost you an additional $40,000 than what you otherwise expected. If you didn't have money in, say, a Roth account, then you might have to take it out of your traditional IRA assets, which could push you into a higher tax bracket than you originally planned for. Having a lot of diversification in your tax buckets can be hugely beneficial in retirement. Now, with that framework in place, let's look at how this year compares to it. Once again, we're going to look at their effective tax rate and marginal tax rate. It looks like their effective tax rate is going to be about 17% this year, and they're going to be in the 24% marginal bracket. That 24% bracket is lower than what it's going to be in the near future, but again, it's going to be the same or lower than what it's going to be during retirement. Because of this, it's an indication again that they want to stop putting money into their traditional accounts and instead either accelerate income today, maybe through Roth conversions, or at least put money into their Roth retirement accounts. But let's see if step 3 changes this at all. Remember, this is where we really refine these different income thresholds to see if they're close to either being able to do something or losing the ability to do something. For David and Mary, the key thresholds are, again, net investment income tax and Medicare surtax. However, for them, these aren't as important because their compensation income is $225,000. That means they're not going to be subject to that Medicare surtax, and their income's quite a bit lower than the net investment income tax threshold at $250,000. However, they are really close to that Roth IRA contribution phase out and are likely going to be over it because of any investment income they have. Remember, they have that $350,000 taxable brokerage account. Finally, they are probably going to be towards the bottom of the 24% tax bracket. Let's see what their situation looks at before any planning. They still have that $225,000 of wage or compensation income. Additionally, they are having about $10,000 worth of dividends. Again, this is something that I would refine throughout the year to make sure that it's as accurate as possible. But for now, we're going to estimate that's $10,000. Together, their adjusted gross income is $235,000. This is right in the middle of that Roth IRA contribution phase out limit, which goes from $230,000 to $240,000 of modified adjusted gross income. Now, the fact that it's modified is very important, and we'll get to that in a second. They are unable to itemize their deductions at the moment. That's because they only get a deduction for their state and local taxes up to $10,000 and $10,000 of donations to charity. However, unlike Noah and Emma, they don't have any mortgage interest at this point, so they're not able to itemize their deductions. That said, because they're donating so much to charity, As I'm going through, I'm thinking, David and Mary, you donate a lot to charity. You might want to look at some techniques to get a tax benefit for your charitable giving. It can be a great way to make your charitable dollars go further than they would otherwise. Now, with David and Mary, they aren't getting any credits that we need to worry about, so we're not doing any planning at that area. Additionally, they're not subject to miscellaneous taxes. Remember, their compensation income's below $250,000 and their MAGI is also below $250,000, so we don't need to worry about this item. These are indications that they may want to accelerate income this year. However, because of that Roth IRA contribution phase out limit, they might want to do something to get below that. That can be a huge number to plan around because it gives you the ability to put even more money in towards your tax-free bucket. And as we mentioned for David and Mary, that's going to be a huge priority for them over the rest of their working careers. Right now, they only have money in their traditional IRAs, 401ks, 403bs, and taxable brokerage account. Most of that money is going to be subject to tax anytime they take it out of their accounts. But before we get to the actual tips and techniques, let's look at their goals one more time. They want to retire within the next 5 years. This is their primary goal, so we're probably going to focus on things that help them achieve that. Moving from Massachusetts to Maine isn't going to really impact their tax situation all that much, so we're not going to do a lot of tax planning there, though we could do some financial planning with them on. We can do some tax planning around charitable giving. This can be a great way to reduce your overall lifetime tax burden by donating to charity in an efficient manner. Now, this is only the case if charitable giving is a goal of yours. If it's not, then giving money to charity definitely does reduce your net worth, so you don't want to do it for the tax benefits alone. So let's look at some of the planning tips and techniques that I would recommend for David and Mary. I would probably have David contribute some amount to his traditional 403b. By doing this, he's going to reduce their income and reduce it to the point that they're below that Roth IRA contribution phase out limit. That's going to start at $230,000 of MAGI. Now, by doing $10,500 into his traditional 403b, they're going to be a few $1,000s below that limit. I always like to leave some room for error. None of us are perfect and things change throughout the year. So we want to make sure we leave a little bit of wiggle room in what we're doing. Now, I would have him contribute the rest of what he can to his Roth 403b. That's going to start building up that tax-free bucket. And I would probably have Mary do the same thing, contribute everything that she can into her Roth 401k account. Then I would have them contribute as much as they can to their Roth IRAs. This is going to allow them to start building up that tax-free bucket and provide a lot of flexibility later on. Another strategy I would say is to convert some amount of money from David's traditional IRA to his Roth IRA. By doing this, they're going to generate additional income this year and have it get taxed at a relatively low rate compared to what they're going to be taxed at in the future. As we saw, their marginal bracket is going to be higher, at least at this time in retirement, than it is now. So accelerating income into these years can be very helpful. This is also going to help build up that Roth IRA bucket. Finally, the last thing I would suggest Mary and David do is donate $40,000 of appreciated securities to their donor advised fund. This is going to have a few benefits for them. One, it's going to get the most highly appreciated stuff out of their taxable brokerage account. If they were to sell those assets, it would generate some capital gains to them, which would be taxable and reduce their overall return. Additionally, by donating $40,000 this year, they're going to be moving above the standard deduction and start getting some tax benefits from their charitable giving. This is one way to achieve their charitable giving goal while doing it in a very tax efficient manner. So let's see what the ramifications are before and after planning. We can see that their wage income has decreased by $10,500. This is from David's traditional contribution. Their dividends aren't going to change because we're really not doing that much with their taxable brokerage account. Although you could argue that their dividends are going to go down slightly because you donated $40,000 of appreciated securities. But to make things simple, we left it the same. Now they are going to have an additional $20,000 of taxable IRA distributions stemming from their Roth conversions. Once we add all of this up, we see that their adjusted gross income after planning is going to be $244,500. Now, you might be saying at this point, hey, Kyle, wait, you said we wanted to get them under the $230,000 mark, but now they're over and completely phase out of the ability to make Roth IRA contributions. And you would be right, other than the fact that one of the modifications to that threshold is that Roth conversions are not included in the AGI calculation. So if we take out those Roth conversions, then their modified adjusted gross income is only $224,500, which is below the phase out limit. This is why it's super important to know the nuances to the tax code, because otherwise you could be leaving more money on the table. If we continue through their projection, we see that their deductions increased from the standard deduction now to $50,000. This is going to reduce their AGI and generate their taxable income number, which is $194,500. They have now moved from the 24% tax bracket to the 22% tax bracket. Not only did they move down in a tax bracket, but they were able to do those Roth conversions and have it get taxed at 22% rather than something higher that they would have been taxed at in the future. Now, they didn't have any changes to the amount of credits that they have because they don't have any children and they don't have any dependent children on their tax return at this time. Finally, they still don't have any miscellaneous taxes. Once we conclude all of this, we see that they saved about $2,500 in taxes this year. Not only did they save money in taxes, but they were able to move money from their traditional account to a Roth account, doing a $20,000 Roth conversion. They also saved over $60,000 in their Roth retirement accounts. This helped build over $80,000 of tax-free assets this year and doing it at a relatively low tax cost. Again, their highest marginal tax bracket at this point is only 22%. This is lower than it's going to be in the future. This is helping them move closer to their goals of retiring in the next few years, while also donating to charity in a tax-efficient manner. Something I didn't mention is that with a donor advised fund, you can donate a large amount in a given year and then make annual grants out of that donor advised fund into the future. Additionally, you can even invest your donor advised fund so it could potentially grow. For instance, David and Mary could have looked at doing like a $100,000 contribution to the fund, allowing that money to get into the donor advised fund, grow in there, and then the investment growth alone could help sustain future years of gifting. This can be a great way to donate to charity in an efficient manner and reduce your lifetime tax burden. Now, throughout our webinar series, we've looked at how working professionals can use different tax saving tips and techniques to limit their lifetime tax burden. We started out by looking at how income taxes work in the US and introduced some of the most common techniques we use with our working clients each and every day. Next, we went through how to identify which options and techniques best fit your needs as working professionals. Finally, today we looked at how to combine these things together to build your own tax plan, focusing on some of the key tax thresholds and income items. While getting a tax plan in place is important, it's also important to update and revisit this plan each and every year, and even doing it multiple times throughout the year to make sure whatever strategies you're thinking about doing still make sense in the context of the current tax environment, your life, and your goals. At the end of the day, the goal of tax planning is to help you save more of your money to propel you towards those financial and life goals, so you're not leaving more money on the table. Tax planning can get complicated, and it can be helpful to work with a financial and/or tax professional whose job it is to stay up on top of all of this stuff. If you're interested in learning more about this, I encourage you to reach out to myself or the Milestone team by visiting our website at milestonefinancialplanning.com or emailing me directly at kyle@milestonefinancialplanning.com. As a reminder, this session is being recorded in case you'd like to reference back to anything we talked about. Now, before we wrap things up, are there any questions? All right, I'll give it another minute or so for any questions. Otherwise, we can wrap things up and you can reach out to me directly at kyle@milestonefinancialplanning.com. All right, since there aren't any questions, on behalf of myself and the rest of the Milestone team, I'd like to thank you for attending this session and hope you stay in touch for future webinars. Thank you and have a great day.